What's up, guys? My name is Hans, and in the next 12 minutes, I will be telling you everything that you need to know about how our economy is affected by the coronavirus pandemic. Let's go! But first, let us start with the basics. Let's say that I have 100,000 pesos today. Where should I put my money to gain the most profit in 10 years? Is it the stock market, mutual funds, bonds, savings, or simply just keep it cash? Well, before the pandemic, people have answered those questions quite simply because the economy was still booming. However, today, as we have encountered the lockdowns and halting of businesses, everything has changed. The market is no longer in an uptrend, the banks are no longer making money, and well, the economy is simply declining. When the economy is declining, everything is affected. However, each one is affected differently. Some take a bigger hit than others. And that is the purpose of this video. We will simply be tackling each one, considering how it was before the virus and how it is now. Now that we know what took effect in the last 9 months, let's proceed to the outline of this presentation. First of all, we will be talking about the 5 different investment options: savings, stocks, bonds, mutual funds, and cash. We will be tackling each one together with their concept, process, risk management, and how the pandemic has affected them. In the end, we will be judging what the best investment plan is, or simply which option could make us the most money today. Okay, let's start with savings. Savings, by definition, basically enables depositors to keep their money in a safe place, which in our example would be the bank. While the money is being kept, depositors also earn a small amount of interest, as technically, the banks are borrowing their money. Before the pandemic, the average return interest rates in a basic savings account in the Philippines was 0.25%, as stated in our book, Essential Mathematics in the Modern World. However, as seen in the picture below in BPI's website, the interest rate today, as of December 11, 2020, is only at 0.125%, exactly just half of what it was before the pandemic. To give an example, if I were to invest 100,000 pesos before the pandemic, I would earn 250 pesos interest after 1 year. However, today, my 100,000 peso investment would only give me 125 pesos, literally half of what it was before the pandemic. To give another perspective, let's look at the quarterly earnings of the biggest bank here in the Philippines, Banco de Oro, or BDO. According to Investagrams, in the second quarter of 2019, BDO had a net income of 10.39 billion pesos. However, as of the second quarter of 2020, which is the same time when lockdowns were still in place, BDO had a net loss of 4.5 billion pesos, negative 4.5 billion. This means that BDO lost money instead of earning profit. As you can see, the pandemic has greatly affected our banking systems here in the Philippines. This is mainly due to the bank's increase in non-performing assets. However, as a response to what is happening in the financial sector, the Senate has approved a Financial Institution Strategic Transfer or FIST Act last November 10, 2020, which is basically a 1.19 trillion peso cash infusion which frees up the bank's non-performing assets. Moreover, the risk management of banks still hasn't changed. It is still a low-risk and low-reward investment. Moving on to the next investment choice, which is my personal favorite, the stock market. To give a background, the stock market is a collection of markets where buying, selling, and issuance of shares of publicly held companies take place. One of the most notable math concepts in the stock market is its use of patterns. Stocks continually go up and go down over the time, which create patterns. Statistics is also one of the mathematical concepts used in the stock market. Furthermore, sophisticated mathematics can calculate the probability of events. This works in the stock market by helping traders maximize their reward and minimize their risk, or as what we call it, the risk-reward management. Personally, being a trader in the Philippine stock market for the past 2 years, I can say that this pandemic had a very major effect. To show you, see this is a chart of the Philippine Stock Exchange Index. We can see that in the left part, the one enclosed in the pink box, that the PSEI reached up to the 8,000 level last 2019. However, when President Duterte announced the lockdown of Metro Manila last March 2020, people got overwhelmed and prices got to a 52-week low at around the 4,000 level. Moving on to the average returns per year. Similar to banks, the stock market was extremely affected. As research by the team of COL Financial, the PSE had an average rate of 10.69 from 1988 to 2017. However, as of November 2020, the estimated year-to-date average return rate in the Philippine stock market got to a 10-year low of negative 30%. With a difference of almost 40%, I believe that this type of investment was the one which is most affected. The major reason behind the sharp fall of prices is that the investors already predicted that businesses will be closed. And as I have said earlier, when businesses are closed, companies don't make money. And when they don't make money, investors don't see the companies being a good investment. Therefore, they don't invest. Moreover, the stock market's risk-reward still hasn't changed. It is still a high-risk, high-reward investment. According to this website below, only 20% of the traders are successful. Therefore, I suggest that if you don't know anything about the stock market, learn about it first before you start investing. For the next investment choice, it is one that is closely related to the stock market. It is the bond market. Bonds are debts issued by the governments and corporations when they want to raise money. So basically, companies borrow money from the people to raise capital. To earn money, on the other hand, bonds give coupon rates. To give an example, let's say that you have invested 100,000 pesos in a 5-year bond which gives 5% coupon rate yearly. Over the next 5 years, the company will be giving you 5,000 pesos per year, and after the end of the bond, the company will be giving you back your initial investment. Therefore, you have earned a total of 125,000 pesos over the 5 years. The main math concept being used here in the bond market is just simple interest. According to the website below, as of December 11, 2020, the average government bond returns per year in the Philippines are 2.747% for 5 years and 3.107% for 10 years. However, private companies such as Philinvest and Megawide Corporation give bonds up to 5% for 5 years. During the pandemic, the bond market wasn't heavily affected as compared to the saving and stock market sectors. The rates stayed the same, with some even going up due to the fact that they needed more money. Since companies need more money as they aren't opening their businesses, they offer high rates. For the risk-reward management of the bond market, since it is a market that isn't volatile or prone to changes in interest rates, it is a medium to high risk and a medium to high reward investment. The only risk in the bond market is the possibility of investing in a company that is leading to bankruptcy. Following, the next type of investment choice that we are going to discuss is a mutual fund. A mutual fund is a type of financial investment made up of a pool of money collected from many investors to invest in securities like stocks, bonds, and other assets. Basically, a fund manager takes care of the money that you've invested and he or she will invest them in the market which he or she believes will make profit. Attached is a picture of the different types of mutual funds here in the Philippines. The second to the last column states the year-to-date return of your investment, which when averaged gives a negative 8%. The year-to-date return is the same as the interest rate, so if you have invested 100,000 pesos exactly 1 year ago, we will have lost 8,000 pesos already today because of the negative 8% year-to-date return. Next, attached is a picture of the year-to-date returns last year. It is seen that the last year's average returns ranged from 5% to a high of 11.54%. With an approximate of almost 20% different from last year's year-to-date returns, I can say that the mutual fund market was also heavily affected because of the pandemic. All in all, I can say that the mutual fund market is a low-risk, low-reward investment. Generally, the mutual fund market generates a profitable investment even at times that the market is down. So even if the economy is down, most mutual funds still generate a 1% to 2% profit as fund managers are already an expert in that field. However, mutual funds will surely drop during unexpected calamities and disasters such as that of today, the COVID pandemic. Lastly, the easiest investment of all, cash. Cash is defined as any form of currency, which in our case is the Philippine peso here in the Philippines. Generally, cash doesn't change. The value of your investment when you keep it as cash will always stay the same. 100,000 pesos today will still be 100,000 pesos after 5 years. However, the only thing that affects cash is the inflation rate. During the pandemic, the wisest choice in my opinion was to keep your money cash. I even knew investors and traders in our Facebook group stating that cash is king. Why, you may ask? The answer is simple. When the ECQ started, nobody knew if the market was stable enough. As I have said, every company was having losses. The stock market, the banks, mutual funds, they were all battling losses. And on the other hand, if you were to invest it in the bond market, there was a high risk at that time, during the start of the pandemic, that companies might go bankrupt. Moving on to the conclusion. I have made a table which shows the basic summary of what I talked about in this video. So, looking at the chart, we can see that as of now, as long as the pandemic is still here, the following are the best choices for each. First, if you are a conservative investor who wants quick access to your money, basically, you need it from time to time, then putting your money in the bank is the best choice for you. Second, in my opinion, do the stock market if and only if you have enough experience. It is indeed true that you could earn from trading. However, due to this pandemic, as I've said, the stocks are very volatile, meaning that they are harder to predict. And if you don't have experience, as seen in the average return of negative 30 for the year 2020, you will surely lose. Third, the bond market is my best recommendation if and only if you don't need the money. Again, bonds mean that you won't have access to your money for a specific amount of time because the companies are borrowing your money. So if you have money for savings to spare, it is better to invest it in the bond market of strong companies such as SMPH and JFC. Quick reminder, make sure that you invest in companies that you know will not go bankrupt. Don't invest in companies that you have never heard of. Fourth, mutual funds could be a possible choice for you if you believe that the worst is over and our economy is on its recovery period. However, personally, I think that it's a bit risky to invest in the mutual funds as of today because of the coronavirus still being out there. And the vaccines aren't available yet. So if you believe that the Philippine economy will strongly recover over the next year, then this is the choice for you. Fifth, cash. Cash is always important, but never put all your money as cash. As I've said, inflation will slowly eat up your money. So just make sure that you have enough cash to live by and invest your remaining savings in investments. Again, I would like to share my opinion. So what my perspective is that it can be expressed through a quote. Always remember to put your eggs in different baskets. I believe that having a healthy investment means having a mix of the ones I mentioned before. For me, keep as cash the money that you're gonna need for the next month, put in a savings account the money that you're gonna need over the next year, and invest all the remaining savings that you don't need in either the stock market, the bond market, or mutual funds. So that's all, guys. Thank you for listening, and I hope that you have learned a lot on investing today, especially on the effects of this pandemic. And always remember, work smart, not hard.